And welcome. This is Mary Ellen McGonigal here with your Friday afternoon MEM Edge show. And as always, this is the show where we bring you where the action is in the broader markets. Another volatile period last week. As usual, I'm going to share with you some of those headline news that drove price action last week. And front and center certainly was anticipation of NVIDIA's earnings, the heavyweight semiconductor, very widely watched as a gauge for investor sentiment relative to technology and risk on. We will get into that. And also today, Fed Chair Powell came out with his annual release of comments from Jackson Hole. And the good news there is that the comments were really as anticipated. It was a repeat of what Fed Chair Powell has been saying. Last Wednesday, there was talk that, in fact, we may need to see interest rates rise further because inflation remains elevated. It's not great news. However, there were no negative surprises. So we did see a bit of a rally today. We'll get into all of that. Also, on the economic front, global recovery efforts in China are continuing to take shape. There is concern that is mounting regarding their potential move into a deflationary period, a lot of difficulty with real estate in that country and elsewhere. So that is impacting, in particular, I would say energy stocks have been the most heavily impacted. And then some of those mega cap global facing companies are stalling or pulling back as well. And then also as it relates to some of the US economic data, we did get some flash PMI data on both the services and the manufacturing side, and it did show a slowdown in the economy. However, durable goods did show that the manufacturing side of the economy is beginning to stabilize. That has been a very weak area. We've seen weakness there due to supply chain issues, increased costs, but that is stabilizing. And then last up, consumer sentiment, and that did drop a bit. We got that number today. That's all about high inflation, economic weakness concerns. So net on the economic front, it was quite mixed. We did get mixed data on the home sales and data as well, where new home sales did come in strong, existing home sales weak. And last up on that news front is the fact that long-term yields remain elevated. So we're going to take a look at that 10-year yield, and in turn, that did negatively impact select areas. We'll get into that as well. Now, next week is going to could be proved to be quite pivotal because we have some very highly impactful data by way of core PCE, that's inflation data that's due to be released. We're also going to get the ever important employment data for the month of August. And this is something that Fed Chair Powell and his team have been looking at very closely. Labor costs have remained high, but in turn, that means that workers are getting more by way of compensation, hence keeping spending high. So no, you cannot rest on your laurels next week. So from here, let's go ahead and take a look at these markets and see where did we close for the week. And here we are with a daily view of the S&P 500 index and a couple of key metrics that you will want to be aware of. And that is the momentum metrics on this daily chart. You can see the RSI is generally trending upward. However, it does remain below that key 50 level in negative territory. And the faster moving momentum indicator stochastics also heading north, but also below that 50 level. So at the end of the day, we are not quite there on that momentum front. And beyond that, we want to pay attention to the position of this index relative to these key moving averages. Certainly most closely watched from my work is going to be the characteristics here right at that 50-day simple moving average. I do need to see a break above that 50-day, as well as positive momentum signals to shift into a positive near-term sentiment for the S&P 500. So at this point, we did on Thursday rally right up to that 50-day. We're denied. Now today, on that 10-day simple moving average, We closed right at that moving average. Other key areas you want to certainly be aware of is key areas of possible support. On the S&P, it is that 4,300 level. And on the upside, if we can get up above this 21-day moving average as well, that would be ideal. I don't think I'm asking too much there, but it certainly would help the case to become bullish on the near-term prospects of the S&P 500. From here, let's go ahead and take a look at this tech-heavy Nasdaq. Clear outperformer this week, up over 2%. And you can see that the index did close above this 10-day simple moving average. Yesterday, we did have a brief rally so that it closed, it did touch above that 50-day simple moving average, but it did pull back. Now, let's take a look at these momentum indicators. RSI trending upward. We do want to get it up above that 50 level, and the stochastics also super close to turning bullish as well. And as many of you may know, I did share this chart last week as well. What I like to do ideally is share with you historical precedents as far as pullbacks that have in turn reversed into an uptrend. So those key characteristics here is back in mid-March, a break above these shorter term moving averages, RSI, and stochastics in positive territory. So good news here is we are very close to that occurring. However, I did mention that next week we do have some very key data ahead of us. So from here, that may stall the markets, but I do want to share with you a view of the underlying sectors in the S&P 500. And these are those 11 sectors sorted by relative strength. And this is all about capturing not only potential sector rotation, but you also want to be aware of where that relative strength is so that you can participate if you're inclined to dip into this market, or make sure you don't have an overweight in those weaker areas. So let's take a look. Energy has been up here at the forefront for several weeks now. It was the worst performer, down about 1.5% due to that weak China outlook. And then also I'll share with you the price of oil also impacting this group. But at the end of the day, the metrics are remaining positive with an RSI up above 50 and the MACD as well. This is an area that many of these companies are coming in with very strong earnings. And there are sound reasons. I talk a lot about this in my MEM Edge report, which you can trial using that link below. So let's take a look at some of these other areas up here at the forefront. Healthcare faltering a bit this week, flat relative to the S&P, up 0.8%. But you can see that it is certainly relative to other sectors holding in quite well. I'm going to share a couple of names in that area that you can certainly at the very least put on your watch list. Here we are with technology, top performing group this week, up 2.3%. And we did yesterday dip into a bullish position with that RSI very briefly before pulling back. However, the XLK technology sector did close the week above that 10-day simple moving average. Keep your eye on this MACD. If we can get a decisive black line up through the red, oftentimes that will signal a new uptrend when coupled with a positive RSI. So certainly good news there, constructive. I'll share with you where the strength is emanating from within technology. But let's go ahead and move on to some of these other sectors that are heavier weighted. And here we are with consumer discretionary, XLY. And we can see that it is very much in a downtrend. This area was up 1.2% for the week, but that's primarily because of these heavyweight names. Tesla up almost 11%. Amazon was flat, but certainly it did not help quite as much as Tesla. But overall, as we move forward, I'll share with you that over the retail grouping, you'll see that retail is really having a tough go of it. Earnings season began for that sub-industry group 2 weeks ago. It's been very mixed, but overall negative in some of these retailers. So from here, let's go ahead and take a look at some of these other areas that are beginning to potentially try and show signs of life. Here we are with retail, REITs, REITs, and this is XLRE, up 0.8%, so in line with the broader markets. We're not quite in positive territory yet, but certainly something you can keep on your radar if you are inclined toward yield stocks that are in there. Now, from here, I am going to move forward and take a look at the sub-industry groups beyond these 11 sectors, because in addition to having a sense of where there may be strength or weakness, it can be more important to really pay attention to those underlying groups, what's driving that strength or weakness. So here we have a number of ETFs that are very helpful in doing just that. And first up here is the yield on that 10-year. And I mentioned that it does remain elevated as long as we are up above that 4% level. It is going to be at an area that generally has a negative impact on the NASDAQ. So we did close the week at 4.2, and we are still trending potentially higher, certainly Fed Chair Powell's comments. But the good news is we did not see a spike relative to that. Also up here at the forefront is software. Now, this is one of the reasons that technology fared the best this week. IGV is that tech software sector ETF, and it was up 3%. Now, this is an area that was positively impacted by earnings. I'm going to share with you some of the names that reported this week. Gaps up into base breakouts, lots of price action, looking quite constructive. Now, on this RSI, we did close above that net neutral 50. And take a look, the MACD black line poised to trade up above that red. So this is definitely front and center on my watch list. Moving through, we can take a look at some of these other tech areas. This is semiconductors, a very mixed group. We all know that NVIDIA came out with great numbers, above estimates, guided higher, nothing but good news. However, the rally on Thursday in response did fizzle into the close, presenting a reversal day, not only for NVIDIA, but for the overall group. Still most definitely on my radar. We can see that this momentum is just on the cusp of potentially turning bullish. But until then, I would not overweight this particular area. And as we take a look at some of these other weaker areas, this is XRT, the retail S&P 500 ETF. And you can see this is that downtrend that I was mentioning, very much below any area of possible support, negative momentum shaping up there. And then also in healthcare, this is one area that is really hurting that sector, and that is the US Medical Devices ETF. This is IHI, and it really has descended well, again, below any key areas of support. I am starting to see a potential leveling off, and I'll share with you at least one name on my radar in that grouping. And also one area that you definitely want to stay on top of are these small cap names. This is IWM, the Russell 2000, and actually for the week, it was not down, certainly it was down about 0.4%, but a potential leveling off taking place there. Now, from here, I do want to share with you some of these retailers, give you a sense of what is taking place there. I'm also going to review a major retail name and use it as an exercise on what to be on the lookout for relative to a big bellwether company falling out of favor. So first up here is DKS. This is Dick's Sporting Good. Very indicative of what we've seen this earnings season, where companies that are at near-term highs, price for perfection, unless they come out with fantastic numbers. Here we are with that huge gap down in price. Now, I've talked about this in the past as far as potentially not something I would favor, but there are those that would like to potentially purchase that pullback, very sharp drop. I would use this late May precedence as guidance because you are in a similarly oversold period. And you're going to want to see that MACD black line up through the red crossing over. For those of you that are more active traders, you can drill down into an intraday chart. Make sure this is a 15-minute chart of DKS. You're going to want to get those momentum metrics into positive territory and potentially trend higher. A lot of these oversold names, you will see a bit of a bounce. A couple of other names that reported this week, Foot Locker came out, and a number of these retailers are citing security and theft issues as partial reasons for their reduced outlook and their poor numbers. So here we are with Foot Locker, another stock, huge gap down, not looking very constructive there. And one last name that we can look at that was a former winner, but more recently is not faring that well, and that is Ulta. Ulta Beauty also had weak earnings back here. The company attempted to recover, but then again, another weak quarter, pushing the stock down. I'm going to pull up a weekly on this chart just to share with you what can take shape with these big winning names. They'll come in with consistent good quarters, and then at some point in time, they'll have a tough comparison to those strong numbers and hence relative weakness. Now, as long as we're on this group, I'm going to have us take a close look at Nike. They did not report last week, but they did experience one of their worst weeks in a very, very long time. So I wanted to go back with this particular stock and share with you the anatomy of a stock that had been a big winner and what takes shape as it begins to fall out of favor. So with Nike, they did report earnings on May 21st. Now, the numbers were pretty good. However, really, investors were taking a close look at their excess inventories, which in turn reduced their profit margins. So we did begin to see the stock flatten out, have this one last gasp rally before deteriorating. Now, once you have a stock that breaks below this key 50-day simple moving average, draw your eye down, take a look at that volume. That high volume is indicating distribution. We also had that MACD enter into negative territory and then continued selling in that stock. Now, in addition to excess inventory issues, the company also is a very global stock as far as their sales, and they were experiencing weakness in China due to lockdown and other issues that were continuing to shape up. So as the stock continues to progress, we can see these rally attempts, but we're not getting that positive momentum that you'll want to see. We're still seeing higher volume on your selling days, indicating distribution and upside resistance at that 50-day simple moving average. The stock continues to trend sideways. And then, of course, this week, over the last 2 weeks, continued selling on weak outlook for the stock. So I did want to share that with you as an exercise so that if you do own some of these bigger names, they're not going to stay in favor for ever. So also moving over to software names, let's take a look at some of these stocks that reported earnings this past week. WDAY came out with numbers today. You can see the stock is on the cusp of a potential base breakout at that 240 level. And what I did want to point out to you that is interesting, and I will need to see a sustained rally in the broader markets to confirm this, but let's take a look at this MACD black line up through the red. When that occurs at a relatively low level, we're just coming above that net neutral zero, your upside potential is certainly going to be quite a bit greater than that taking shape later. Also, we can see on that RSI just turning positive above that net neutral 50. And then, of course, if we can get that base breakout at 240, super high volume on the release of their numbers, very similar to the end of May, high volume base breakout characteristics. So definitely one for the watch list. Another name that did come out, SPLK. This is Splunk. And here we are, big gap up on Thursday in response to strong earnings. That gap up in turn pushed the stock out of a base formation, and it did so on very high volume. Now, given the current uptrend and the rally that has shaped up, we are in an overbought position. As always, you don't want to chase the stock, certainly not in this environment, but net intermediate term, Splunk does appear to have further upside. One last name we can take a look at that I'm sure you're familiar with is Intuit, INTU. Very similar characteristics with that move higher into a base breakout. Take a look, MACD, black line up through the red, poised for further upside, likewise with that RSI. So nice names here for your watch list if we continue to see strength in that technology area. From here, those of you that might be a little more cautious going into year end, I do have a list of names that are yield providers, and they are also looking quite constructive. First up here is IBM. They came out with their numbers back here with a gap up that did progress into a base breakout. And then this week, another base breakout. The company does have a 4.6% yield, and you can see a nice uptrend beginning to formulate. From here, let's go ahead and take a look at IRM. This is Iron Mountain, and the company provides security for documents and other items, and we can see that we are experiencing this stock did have a pullback below that 50-day, recovered quite nicely, and very similarly with that RSI, MACD actually poised to have that nice crossover, and then the momentum on that RSI trending upward. This particular company is a 4.3% yielder. They did come out with earnings early this month, 22% above estimates. Next up here is HRB. This is H&R Block, and the company did report about a week and a half ago. Take a look at that huge gap up, tremendous volume. Not so much about their earnings, but the company really did quite a bit by way of cost cutting and hence revise their outlook higher. Now, what we're happening in here, I'm going to go ahead and add a 5-day simple moving average, and you'll see that the stock is finding support at that upward trending moving average, just ever so nicely trending higher. Another yield name that is beginning to potentially return into favor, but a little too early from my work. This is McDonald's, MCD, nice 2.1% yielder. Let's take a look at this stock because you can see that over the past week, we've seen a steady progression higher as it begins to move above these areas of upside resistance, 5, 10-day. Next up is going to be that 21-day simple moving average, but we're seeing nice volume on this advance. Now, from here, of course, we will want to go ahead and get those momentum metrics into positive territory. They're not quite there yet, but I would keep this on your radar. This is a name that I added to my MEM Edge report back here in March, and you can see the nice steady advance. I did remove the stock as it began to break down. However, one for the watch list for sure. And from here, I did talk to you about the energy sector. So we can take a quick look again at that sector chart and get a sense that by and large, it's pretty much the healthiest chart out there. Now, again, there are potential headwinds with China's economic slowness. And I don't believe that we took a look, but let's go ahead here, take a look at Brent crude oil, and you can see that unfortunately it is generally trending lower. Now, for the price per barrel of oil, that $80 level is rather impactful, and we did close the week at 83, but you will want to have this in the back of your mind as it relates to the price of oil impacting select energy names. But here's a stock, it's not a direct oil name, but they do provide services to the oil and gas area. And this is Fluor. FLR is the ticker symbol. Here's that gap up on earnings. The stock pulled back rather dramatically to this 21-day simple moving average. But let's take a look. The RSI did remain in positive territory, and likewise with that MACD. Now, what we can do from here is go ahead and pull up that full quote. We want to see, does the stock offer a yield? It does not, but certainly of note. Another name that is not super widely watched, actually, that is not the name that I wanted, but this is a good example of companies that have these gaps down and attempt to rally. That's Chipotle there. And as we move forward, I did want to take a look at some of these retailers that came out with numbers last week and have pulled back very orderly. This is ROST Stores, a major discount retailer, and we can see this nice advance as the company continues to trend higher after reporting strong numbers. I'm going to go ahead and add that 5-day simple moving average, and you'll see that pullbacks to that 5-day have proven to be an ideal buy point. Another company that reported earnings last week is this Arista Networks, ANET. Now, this pullback is certainly a bit more dramatic, but we are still above that 21-day simple moving average. And as it relates to a company that is somewhat in that retail space, came out with great numbers 2 weeks ago, gapped up into a base breakout and still trending higher. This is Celsius Holdings, CELH. I did promise a healthcare name, and it is a company that was on my MEM Edge report during its uptrending phase, fell out of favor. Let's take a look if I can get the ticker symbol. And here we are. This is Intuitive Surgical. This is a stock that we added back here prior to their gap up on earnings into a very nice uptrend. And then we did, of course, remove the stock from the suggested holdings list as it fell out of favor. What I'm viewing here at this time is the fact that the stock is attempting to reverse that downtrend. Be on the lookout for a black line up through the red, ideally get that into positive territory with a positive RSI. We're coming out of an oversold position, so we'll keep our eye on this one. And everyone have a fantastic weekend. I'll be looking out for you here again next Friday.